So Blackstone has purchased Home Partners of America in sort of the latest episode of the ongoing saga of hedge funds and private equity and Wall Street in general moving into the housing market. Now, Home Partners of America is an interesting firm because they don't, they're not they're not like a mortgage lender, and they're also not a landlord. They do rent to own essentially, or I guess it might be a form of owner financing. I'm not sure if they own well, I guess they would own the underlying properties if they're renting them to people. So they do a form of owner financing, I guess, to where you rent from them for a little while, and if you like the house, you can decide to transition from a lease into a mortgage, hence the shorthand rent to own. If you notice, a lot of places that sell sheds seem to offer programs like this. They don't know if you're going to be a good credit risk or not, so they lease it to you for a while to see if you're going, if you can consistently make your payments every month or every week, in the case of most rent-to-own schemes, because they don't trust you that much. But once you've built up a bit of a rapport with the landlord, they say, you know what, I'll turn this into a mortgage for you. And so what this is yet another way in which these hedge funds and private equity groups are trying to chase a higher and higher yield. Because this is probably, I would think that this is maybe not as lucrative as being a landlord. However, it might be less headache, and it's still going to be a much higher yield than traditional mortgage lending. Because as of right now, mortgage, which by the way, hedge funds and private equity groups never engage in lending people money to buy houses. They're not lenders. That's not how these funds typically work. These are guys who, buy bonds and stocks and that sort of thing. Financial instruments, maybe mortgage-backed securities they'll buy, but they're not going to be originating mortgages. But now they're kind of getting into that business. But the kind of mortgages, from what I understand, that Home Partners of America would be writing are not the kind that they would be pawning off on Fannie and Freddie. These are not going to be like FHA mortgages that have little money down and a very low interest rate. The Home Partners of America, their idea is trying to lend to people who otherwise can't qualify for a mortgage, who can't go through traditional lending channels. And so I'm fairly certain that they plan to keep these mortgages on their books, which is quite interesting. It's not something that you see much these days. Normally, banks just want to write the mortgage, and they want to pawn it off on Fannie or Freddie, and then it gets packaged in, pardon the pun there. Maybe it's because I was thinking of sausages, which is a good analogy for mortgage-backed securities that George Gammon uses often. Now, of course, if they're going to be holding these mortgages on their balance sheet, they're going to want a higher yield than a typical mortgage. And so this gives Blackstone a way to get their foot in the door of what is essentially the high-yield mortgage market. Because this is something that has pretty much disappeared in the last few years. It has become rather difficult to qualify for a mortgage, but if you do qualify, you pay almost nothing in interest. That's generally the rule now. Whereas in a normal functioning market for money, a market for loans, you should be able to move out the risk curve. And even if you are a riskier person who might not qualify for a loan that, with only a 2.9% interest rate or a 3% interest rate, maybe the risk of you as a borrower would justify an 8% interest rate. But you don't have that option. It's not like the bank is going to say, okay, we'll lend it to you, but this is going to be your interest rate. We have to account for your default risk, which is higher than a normal person. They're just going to say, well, flat out, we're not giving you a loan, because those kinds of loans aren't being bought by Fannie and Freddie. And that's all they want, is they want to be able to buy a loan that they can then sell and get the money today, They just make a small spread on that, and then those loans get packaged into mortgage-backed securities, and there's somebody else's problem. Now, what this also represents is that um, this is kind of a blow to the idea of the Great Reset as an ideological movement that is really entrenched in on Wall Street. This Home Partners of America purchase, unless Blackstone just purchases them and then folds them up and liquidates them tomorrow and destroys the business, is not the kind of thing that a company who is trying to eliminate the idea of private home ownership in the United States would do, because this is a company that enables people who ordinarily would not be able to purchase a home to purchase a home. This is the kind of purchase that, rather than trying to make homeowners in the United States extinct, it would just seem that this is purely motivated by them wanting to make profits, which is why I think that I think that was the main motivation behind all of these Wall Street firms buying up all of these rental properties. It's because they have a higher yield than bonds, and as long as they can make 6-7%, these guys are happy with that. 6-7%, of course, after paying a management company to actually manage the rentals, that is. But it's not so much that these guys in particular care so much about making sure that nobody can own a home. It's that they just want to make a certain rate of return. Now, you could argue that the central banks and stuff, and the folks who actually push interest rates down so low, are encouraging this behavior because they don't want ordinary Americans to be able to buy a home, because they want to force Wall Street into the housing market in order to generate a decent yield. But again, then you get into mind reading. I'm just saying what the evidence suggests here is that these guys just care about getting a higher yield. And so to me, that's good news. I would much rather think that than to think that these guys are just gross vampires who want me to live in a pod and eat bugs. Blackstone has a lot of money. They could expand this Home Partners of America company, and not that I think that it's a good idea to buy a home in this market, or that you should be lending, but let's just say for the sake of the future, maybe, in the abstract, I think it's a good thing to see a company that is willing to make loans to riskier buyers who won't necessarily qualify for traditional conventional or FHA or USDA mortgages. People should have the ability to move out the risk curve and to just choose to pay, hey, instead of paying 3%, I will pay 5%. I understand that that's above what the market interest rate is, but I'm riskier than the average borrower. And so I'm willing to pay more on a monthly basis. I mean, heck, people back in the 80s had to deal with double-digit mortgage rates, and they took them. Of course, housing prices were a lot lower back then, and so you could, as well. I mean, that was a reason why housing prices were a lot lower back then, because people couldn't afford a big principal if they had to pay so much in interest. So I don't really think of this story as a good thing or bad thing necessarily. It is just a product of the current environment in which we live, where financial institutions are having to chase yield in non-traditional ways. And the other thing that this shows to me is that these Wall Street firms, kind of like back in 2008, are becoming heavily exposed to the housing market, which is interesting to me. Because back then, it was because these guys all had mortgage-backed securities on their balance sheets, and nowadays they go, oh, mortgage-backed security, I don't want that. I have memories of 2008. They say, oh no, I don't want to be the next Lehman Brothers. And so they go out and they find different ways of exposing themselves, of getting exposure to the housing market. And methinks that when things start to take a turn for the worse, when this market in housing starts to move in the other direction, these guys are going to probably want to exit their positions fairly quickly. But the door, I think, is going to be pretty small. I mean, these guys are buying up a lot of properties. And if interest rates ever start to rise, as I've said before, Wall Street is not going to want to be in the housing business. It's too much trouble. They would much rather just buy and sit on a bond, or buy an index fund or something like that, if they can make what they're making right now. If they can make 6-7% in any other capacity, if they can do it with junk bonds, they'll do that. They'd much rather just sit at their computer and not have a real physical asset that they have to worry about. And especially when you look at them getting into a company like this, Home Partners of America, that actually, I think, sits on their mortgages, because who's going to buy them? These are not the kinds of mortgages that are guaranteed by the federal government. They're not going to hawk them off to Fannie and Freddie. They're going to have to sit on them for 30 years. So I don't know what they're thinking. Are they just thinking that home prices will go up forever? Because that's not going to happen. At least I don't think it can. I mean, it would suck if it does, because then I'd never living anywhere. I guess I could move to Costa Rica or something. But at some point, all of these rich boomers are going to die off, and the younger generation is not going to be able to keep up this same level of demand for housing, because we just can't afford it. I mean, I'm talking to real estate investors now, normal people who buy, and sell houses, or buy houses and hold them to, to rent them out, to, make money off of them, and it's too expensive for them. The prices right now don't really make sense from an investor's perspective, unless you're one of these big hedge funds who's willing to make single digits on a rental. And so we're getting to the point to where I think you're going to see, your more traditional real estate investors dropping out of the market. It only really makes sense to buy a house right now if you're one of these funds, or if you are a homeowner and you just really need, or you're an individual and you need somewhere to live, and so you buy a house for that reason. But even still, you're buying it at a very high price. Who knows if you're even able to afford it? It's just the latest update on the housing market in my area. A neighborhood that is not necessarily the hood, but is hood adjacent. It's right across the road from the hood. I saw a home in there, not very nice, not very big or anything, listed, and how listings work. They go in a day or two, and usually over asking price. Listed for, I think, $250,000. Now, I've been, that $250,000 number is something that I keep watching, because, for most of my life that I recall, you could buy a really nice house for $250,000. And so when I see houses that I regard and that I recall being, cheap at some point and not being very, very nice houses, hitting that $250,000 mark, it psychologically, has an impact on me. I remember when the neighborhoods around me started hitting $250,000, and not nice houses, like maybe 1,000 square foot, like 2.2 or 3.2, like 60s era houses, with terrazzo floors and crap like that. Carports, not even a garage. $250,000, and I was shocked. Now, the only neighborhoods where the houses aren't worth at least $250,000 really is the hood. That's the last neighborhood left, is the hood. We've already started to see mortgage apps are dropping. Less people are applying for mortgages. I think last I checked, actually existing home sales, I think, are coming out tomorrow, so that'll be an interesting number to see. But I believe the last couple of months they've been decelerating. I don't know if they've been outright dropping. I should have, I didn't look at that before. This is just, I'm trying to go off of memory now. But I think we might be approaching a tipping point. Now, that doesn't mean that you get a crash after that, because it doesn't necessarily cause a crash. A rise in interest rates is what would cause a crash. So you know what? Now that I realize that the home sales data is coming out tomorrow, I'm going to end this off here and pick up tomorrow discussing that and seeing what that tells us about the direction that housing is moving right now. Because again, I think I'm outside the mainstream of ordinary people when I say that I think that Wall Street's taking a huge risk here in jumping headlong into the housing market, and that their enthusiasm now would easily sour when things take a turn for the worst, and that could be a good opportunity for ordinary Americans who can't afford to buy a house right now, the Wall Street might exacerbate any potential decline in housing because they may very well want to exit their positions very quickly. And housing is a notoriously illiquid market. It usually takes quite a while. This period where it only takes a few days to sell a house. This is an anomaly. And so, sure, right now, if all these hedge funds wanted to get out of their housing market positions, it would probably be pretty easy for them, relatively speaking, by historical standards. But at the point in which there are other assets that they could purchase that have a yield that they'd be comfortable with, but are less trouble to deal with and less risk, perhaps. Well, risk is probably the wrong word, but less trouble to deal with than housing. They're going to have trouble getting out of those positions then, and they might push the market towards the downside more quickly, and that will make it easier for people like me to finally get into the housing market. So I'll see you folks back here tomorrow.